Lecture 7. Smart Investing Made Simple. If all you did on your quest for financial freedom was increase your income and decrease your spending, you would make slow and steady progress toward your goal. But your progress would likely be too slow to ever reach financial independence or to retire early. Fortunately, there's an easy way to accelerate your saving: smart investing. This is a huge topic, of course. Today, in the 30 minutes available to us, we'll cover some of the basics. Investing isn't nearly as complicated as some people would have you believe. If I do my job correctly, by the end of this lecture, you'll understand investing fundamentals and have a plan for your money. To start, it's important to understand that if you choose not to invest, you actually lose money. Let me explain. Let's say you followed my recommendations in previous lessons and have been able to create a $2,000 monthly gap between what you earn and what you spend. Every year, you're setting aside $24,000. That's amazing. Now, if you were to take this $24,000 and tuck it under the proverbial mattress, after 20 years, you'd have amassed $480,000. Awesome, right? But wait, we're forgetting one thing: inflation. Inflation is the silent enemy of wealth. It doesn't destroy your savings all at once, but, like rot eating away at a home from the inside, inflation slowly destroys your financial foundation. Inflation, of course, is that gradual increase to the cost of goods and services over time. The fast food cheeseburger that cost 50 cents when you were a teenager costs $1 today. That's inflation. A low and steady rate of inflation is generally considered part of a healthy, growing economy. In the United States, government policymakers aim to keep inflation somewhere between 2 and 3% annually. This allows the economy to flourish. But there's a catch, especially for those of us who save. Even low rates of inflation gnaw away your nest egg over time. In the 20 years between February 2000 and February 2020, for instance, prices rose just over 50%. If you had saved $24,000 in the year 2000, it would have been worth roughly $16,000 in 2020. And if you had saved $24,000 every year between 2000 and 2020, that $480,000 would have been the equivalent of about $400,000 back when you started. Your wealth snowball wouldn't have melted completely, but it would have lost about 18% of its purchasing power. Fortunately, you have a tool at your disposal to fight inflation, and that tool is investing. If instead of hiding your money under a mattress, you had invested it in the stock market, your wealth snowball would not have eroded. In fact, it would have grown much larger. Using rudimentary calculation based on actual stock market performance, your $480,000 of investments over 20 years would have grown to something like $1.1 million. And that's with several years of terrible stock market returns thrown in. Most people know they should invest for the future, but many are scared to start. It seems complicated and overwhelming. One of the problems is that the investing world is filled with jargon. What is a stock? And what's a bond? How are they different? Plus, we're bombarded by conflicting opinions. One guru says that you should buy real estate. Another says to buy gold. One pundit argues that the stock market is headed for record highs. Her partner says we're due for a correction, whatever that is. But perhaps the biggest problem is complexity. Or, I guess I should say, perceived complexity. To survive and seem useful, the financial services industry has created an aura of mystery around investing, then offered itself up as a light in the darkness. As amateurs, it's easy to buy into the idea that we need a professional guide to lead us through the jungle of finance. Fortunately, you don't need a guide. Investing doesn't have to be difficult. You can do this. You can invest on your own and receive reasonable returns, all with a minimum of work and worry. While there's no universal method of investing for financial independence, the strategy I'll share today is one that some of the world's most successful investors recommend for average folks like you and me. Warren Buffett is one of the greatest investors in history. Since 1964, his holding company, Berkshire Hathaway, has earned double the compounded annual gain of the U.S. stock market. If in 1964 you had invested $10,000 in the stock market as a whole, which you couldn't actually do at the time, your money would have grown to nearly $2 million by the end of 2019. Not bad. But if you had invested that money in Berkshire Hathaway instead, your wealth snowball would have ballooned to $260 million. That's insane. So what's Buffett's advice for average investors? My advice could not be more simple, he wrote in a 2013 letter to shareholders. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I believe the long-term results from this policy will be superior to those attained by most investors. Now, if index funds are good enough for Warren Buffett, they're good enough for me, and they're probably good enough for you too. But what are index funds, and why does Buffett like them so much? In this lesson, we'll cover 8 fundamental rules of investing, and I'll explain why these rules lead us to the conclusion that most investors should be following Buffett's advice. The first rule of smart investing is simply to start. It doesn't matter how much money you have. What matters is that you begin investing, then make it a habit. It's human nature to procrastinate. A lot of people put off investing because real life gets in the way. They tell themselves they'll start next year. Then, when next year becomes this year, they promise to start the year after that. This goes on and on and on until they reach age 40 and realize they still haven't opened their first investment account. The cost of these delays is enormous. Let's look at an example. Emma is a 20-year-old woman starting her first job. She makes a one-time contribution of $5,000 to a retirement account. Her money manages to earn a 7% annual return. If Emma never touched that money, it would grow to over $100,000 by the time she was 65 years old. But if she were to wait until age 40 to make that $5,000 investment, well, then her wealth snowball would only grow to about $27,000. The power of compounding becomes even greater with regular investments. It's great that Emma's one-time contribution of $5,000 grew to $100,000 in 45 years, but look what happens if she makes saving a habit. If Emma were to invest $5,000 every year from age 20 to age 65, and if that money were to obtain a 7% annual return, her wealth snowball would grow to over $1.5 million by the time she reached traditional retirement age. During that period, she would have contributed $230,000, and compounding would have done the rest. Because of compounding, the amount of money you start with isn't nearly as important as when you start. When it comes to investing, procrastination is the assassin of wealth. Each year you delay makes it more difficult to achieve your goals. Now, I'm willing to bet that most people listening to this course aren't 20 years old. You're 30 or 40 or 50. I'm also willing to wager that many of you haven't begun investing for retirement. Is it too late? No, not at all. Obviously, your wealth snowball won't have as much time to grow as Emma's, but it does have time and it will grow. But only if you start. Start as soon as you can with whatever cash you have available. Now, a lot of folks believe that investing requires tracking daily stock market movement, then buying and selling based on that movement. But you know what? That's the opposite of how successful investors do things. The second fundamental rule of smart investing is to think long term. Investing is a waiting game. It requires patience. In the short term, stock market returns fluctuate. The price of a single stock might be $90 per share one day and $85 the next. A week later, the price could soar to $120 per share. And it's not just stocks. The value of other investment vehicles fluctuates too, although perhaps not as wildly. Short-term returns are not an accurate indicator of long-term performance. What a stock or fund did last year doesn't tell you much about what it will do in the coming decade. In his excellent book, Stocks for the Long Run, Jeremy Siegel analyzes the historical performance of several types of investments. His research shows that since 1926, stocks have produced an average real return, that is, an average inflation-adjusted return, of 6.8% per year. Long-term government bonds have produced an average real return of 2.4% per year, and gold has produced an average real return of 1.2%. What about real estate? Academic research shows that residential real estate returns less than 1% over the long term. It's true that real estate has done well in recent years, and serious real estate investors can make good money. but doing so requires a lot of time, effort, and specialized knowledge. The bottom line is that your home is not an investment and you should not treat it as such. Anyhow, the point I'm trying to make is that although stocks come with short-term risk, they provide handsome returns over longer periods of time. Yes, from day to day, the price of any given stock can rise or fall sharply, and even over one-year periods, the stock market is volatile. But here's the thing. When you're investing for retirement, you don't care what the stock market does during a one-year span. You're in it for the long haul, for 10 or 20 or 30 years. And over time spans like these, over decades, the stock market has always gone one direction, up. Over time, the wild yearly fluctuations even out, and stocks provide roughly 7% of annual growth for your wealth snowball. While the stock market as a whole returns a long-term average of 10% each year, or about 7% when adjusted for inflation, individual stocks experience drastically different fortunes. In 2019, the S&P 500 stock market index grew almost 29%. But some of the 500 companies that make up that index did much better than others. For instance, stock in advanced micro devices rose 148%. Apple was up 86%. Amazon gained 17%. But meanwhile, Kraft Heinz dropped 25% and Macy's fell 43%. So how can you tell which stocks will rise and which will fall? You can't. Truthfully, even the experts struggle to do so, and they're better educated and have more information than you and I do. Picking individual stocks isn't really investing, it's gambling. I know this from personal experience. In the year 2000, for instance, I bought Palm Pilot stock at about $90 per share. A year later, those shares had lost 90% of their value. I'm a smart guy, or I like to think I am anyhow, but I've still lost thousands of dollars trying to invest in individual stocks. This brings us to Rule 3 of smart investing: spread the risk. By owning more than one stock, you reduce your risk of loss. If you have 10 stocks and one of them tanks, the damage isn't as bad because you still own 9 others. True, this means you don't earn as much if a lucky pick skyrockets, but the smoother ride is usually worth it. Investors also spread the risk by owning more than one type of investment. As we've seen, stocks provide better returns than bonds over the long run, but over short time spans, stocks only beat bonds about 2/3 of the time. And because stock and bond prices tend to move independently of each other, you can reduce risk by owning both. Individual investors often spread the risk when investing through the use of mutual funds. Mutual funds are collections of investments. They let people like us pool our money to buy small pieces of many companies all at once, something we wouldn't be able to do otherwise. Now, I've picked a random mutual fund to use as an example, the Fidelity Balanced Fund. At this moment, this fund owns stock in 2,116 different companies. It holds bonds from 989 different issuers. If you were to buy one share of the Fidelity Balanced Fund, you would own a piece of more than 3,000 different investments. Each year, some of these would gain value and some would lose value. Because the fund allows you to spread the risk, because it's diversified, you miss the highest highs, but you also avoid the lowest lows. Plus, when you own a mutual fund, somebody else does the research and buys and sells the individual investment so that you don't have to. Because mutual funds offer so many advantages to small investors, they've soared in popularity over the past 50 years, but they're not without drawbacks. The biggest drawback to mutual funds is their cost. With stocks and bonds, you usually only pay when you buy and sell. But with mutual funds, there are ongoing management fees built in. Which brings me to rule number 4 of smart investing: keep your costs low. Study after study has found the same thing. The best way to predict a mutual fund's future performance is to look at its fees. Mutual funds with lower fees tend to have better long-term results. There are a couple of ways that mutual funds can cost you money. First, most funds are run by a team of people who research opportunities, buy and sell individual investments, and so on. These so-called actively managed funds subtract their operating costs from whatever money they earn or lose for investors. Second, Some funds carry a load, which is a one-time sales charge or commission. When you purchase a mutual fund with a sales load, you're handicapping yourself before you even begin to run the race. Fortunately, there's an alternative to expensive actively managed funds. An index fund is a passively managed mutual fund designed to follow the performance of a specific benchmark, like the Dow Jones Industrial Average or the S&P 500 Stock Market Index. Because these funds try to match an index instead of beat it, they don't require as much intervention from the fund manager and her staff, which means they cost less to run. The average actively managed mutual fund has a total of about 2% in costs each year. A typical passively managed index fund comes with costs of only about 0.25%, and many are cheaper than that. So, to outperform an index fund, the average active fund manager doesn't just have to match the market, she has to beat it by 1.75%. So remember, to maximize investment results, keep costs low. Index funds offer another great advantage for individual investors. They're simple. And rule number 5 of smart investing is to keep things simple. To build a properly diversified investment portfolio on your own is time-consuming and expensive. You'd have to research and purchase each individual security. For each company in which you purchase a stock, you'd have to understand not only that company, but also that company's competitors and the industry the company is in. After all that, your portfolio would likely contain only 20 or 30 investments. That's some diversity, but not a lot. With index funds, however, you're able to own the entire market with no research at all. Take the VFINX fund from Vanguard, for example. This fund owns all of the stocks in the S&P 500 index and in the same proportions as they exist in the stock market. Or there's VTSAX, the Vanguard Total Stock Market Index Fund, which gives investors exposure to the entire U.S. stock market, not just the 500 largest companies. When you own a share of VTSAX, you own a piece of the entire U.S. economy. Index funds simplify the investing process. In fact, like Warren Buffett, I've come to believe that index funds are the only investment the average person needs to hold. They provide lower risk, lower costs, and lower taxes than stocks or actively managed mutual funds. Yet, because of their broad diversification, they provide the same returns as the stock market as a whole. Which index fund is best? Well, really, any broad-based index fund from any large, reputable fund company will suffice. Just pick a fund and start. The next step is to remove yourself from the equation. Rule 6 of smart investing is to make it automatic. For some, it can be very tempting to manually manage retirement investing. It becomes like a game. They try to guess the best time to make each monthly contribution. But this is a bad idea. In fact, trying to time the market can be extremely costly. Statistics show that despite the stock market's ongoing wins, the average investor underperforms the stock market as a whole. The primary culprit is market timing. During the 10-year period ending in 2017, the S&P 500 returned an average of 8.5% annually. The average investor in stock market mutual funds, on the other hand, earned only about 5% during that decade. Why? Because people try and fail to guess how the market will move. They panic and sell when prices drop, then they buy back as prices rise. As a result, there's a behavior gap between stock market returns and the returns of individual investors. So, to combat this, it's best to automate your investing as much as possible. If you plan to invest through your employer's retirement plan, contact HR to have contributions automatically taken from your paycheck. You should contribute at least enough to get the full employer match if one is offered. Unfortunately, many company retirement plans don't offer index funds. If this is true in your case, you'll have to do a bit of research. Look through the available options to locate the funds with the lowest costs and the greatest diversification. So-called life cycle or target date funds are an excellent alternative. If your employer-sponsored plan has limited choices, ask if it's possible to expand the options. If you plan to invest on your own, whether that's in addition to or in lieu of investing through your employer, decide which company offers the fund or funds that you'd like. Then contact that company directly instead of going through a broker. Nowadays, it's very easy to set up automatic investments through a mutual fund company website. For a more detailed discussion about the virtues of automated investing, check out David Bach's book, The Automatic Millionaire. Successful long-term investors follow another important rule. They tune out the noise that surrounds investing. They ignore the financial news. They ignore advice from their friends and family. They ignore everyone. Successful investors have a plan, put that plan into action, and they make it automatic. Then they forget about it. The seventh rule of smart investing is to ignore the noise. In his book, The Simple Path to Wealth, author J.L. Collins offers a brilliant analogy. Collins says to imagine that a friend has poured you a beer out of sight and into a dark mug that you can't see through. When they hand you the mug, you have no way of knowing how much of what's inside is beer and how much is foam. If your friend poured carefully, there will be very little foam. But if they were sloppy, the glass might be mostly filled with foam. The stock market, Collins says, is like this mug. It contains both beer and foam. The beer is equivalent to the actual businesses of which we can purchase shares. The foam, on the other hand, is all of the noise. It's the pundits on TV and the newsletters and the hot tips from friends. We, as long-term investors, don't care about the foam. We're in it for the beer. And we know that, given enough time, the foam head will subside so that we're left with only beer. It might seem reckless to ignore financial news, but it's not. In a Harvard study of investing habits, researchers found that investors who received no news had better results than those who received a constant stream of information. If you're saving for retirement in 20 or 30 years, today's financial news is mostly irrelevant. It's foam. So make your investing decisions based on your long-term financial goals, not on whether the market jumped or dropped today. And especially, ignore the hot stock tips from your coworkers and your crazy uncle. Forget about the foam, focus on the beer. The final rule of smart investing, rule number 8, is to conduct an annual review. During any given year, some of your investments will have higher returns than others. For example, if you started the year with 60% of your portfolio in stocks and 40% in bonds, you may find that at the end of December you have 66% in stocks and 34% in bonds. What's more, your goals might have changed, or you might discover that you can't stomach as much risk as you thought you could. To compensate, schedule a time to review and rebalance your portfolio once per year. At this time, evaluate your investments and how they relate to your long-term plans. Then, if you need to, shuffle money around so that your asset allocation is where you need it to be. There are 2 ways to rebalance a portfolio. First, you can sell your winners and buy your losers. By selling investments that have grown and buying those that lag behind, you're selling high and buying low, just as you should be. Be aware, though, that this method of rebalancing can have tax consequences. Be sure to check the implications before you sell any securities. A second option, if you can afford it, is to rebalance by contributing new money to your investment account, buying more of the assets that have been lagging behind. This method won't create a taxable event, but it does require that you have cash on hand. Now, rebalancing might sound like active investing and market timing, which I just warned you against, but it's not. Rebalancing is a scheduled, systematic step meant to make sure your investment portfolio remains aligned with your long-term plans. It's not an attempt to outguess the market. Although most investment pros swear by rebalancing, there's some research that shows it might not be as important as once believed. Vanguard founder Jack Bogle once wrote, "Rebalancing is a personal choice, not a choice that statistics can validate. There's nothing the matter with doing it, but also no reason to slavishly worry about small changes." So, while you should indeed review your investment portfolio each year, there's no need to get overly concerned if your target asset allocation is off by a few percentage points here or there, especially if you'd end up paying a great deal in fees or taxes by rebalancing. Okay, we've covered a lot of info in this half hour. Let's put it all together. One smart, easy-to-understand investment strategy for early retirement is to buy and hold index funds. Put as much as you can into these funds and do it as soon as possible. Contribute to tax-advantaged accounts such as your IRA and 401k, before funding taxable accounts. Although you'll put most of your money into a low-cost stock index fund, you'll also want to spread the risk by putting some of your money into a bond fund. How much should you have in bonds and how much should you have in stocks? There's no universal answer to this question. One common guideline is to use a 60-40 split. Dedicate 60% of your investment portfolio to stocks and the remaining 40% to bonds. This so-called balanced portfolio allows investors to enjoy long-term market gains while softening the blows that come when the market crashes. Whatever asset allocation you choose, it's important to understand one thing. Research into sustainable withdrawals during retirement shows that in order to maximize the longevity of your wealth snowball, when you quit work, you should have at least 50% of your portfolio in stocks, but no more than 75%. If all of this seems too complicated, it's still possible to follow a passive indexing strategy through the use of single standalone funds. Most fund companies offer what are known as target date funds or lifecycle funds. These funds are intended to age with account holders. If you aim to retire in 2040, for instance, you would pick a target date 2040 fund. Today, that fund might comprise 85% stocks and 15% bonds. But as time goes by, its asset allocation will become less aggressive. By the time 2040 rolls around, it might be split 50-50 stocks and bonds. Here's one thing you should know about these funds, though. They're balanced for average risk tolerance. If you already know that you're not comfortable with a lot of risk, pick a target date fund intended for somebody older. Don't pick the target date 2040 fund, pick the target date 2030 fund instead. On the other hand, if you have a higher risk tolerance, you might be better off with a more distant target date. Are there alternatives to index fund investing that might provide similar returns? Sure. But these approaches require greater education, sophistication, and attention on the part of the investor. Unless you know for a certainty that you have this education, sophistication, and attention, you're better off sticking with index funds. A solid rule of thumb is this: if you have to ask what to invest in, you should almost certainly stick to index funds. Later, if you'd like, you can learn how to manage rental properties or invest in startup companies. You can explore dividend investing or the so-called permanent portfolio. For now, to start, stick with the basics. The basics work. The basics work so well, in fact, that many in the FIRE community never invest in anything other than index funds. I've done my best to convey the virtues of index investing in 30 minutes, but if you'd like a more thorough explanation, I highly recommend the book I mentioned earlier, The Simple Path to Wealth by J.L. Collins. We've now covered the basics of financial independence. We've talked about purpose and profit. We've explored income and expenses and investing. In our next lesson, we'll turn our attention to what I expect is your burning question. How much is enough? How can you know when you've reached financial freedom?